I know that I don't know anything, but I also know that nobody else knows anything. There's a saying that even if you knew the news the day before, you don't know how the market is going to react to it. So I don't really trade off of any of it, but I look for it as a catalyst.
Welcome everybody to another edition of the Traders Mindchat Show, where we talk to professional traders from around the world to get into their mindsets, their beliefs, what makes them tick, and how they became so successful. Today, we have Larry Tentarelli on the Traders Mindchat Show. And before I get into his resume and why Larry's so awesome, I've been following Larry now for about 7 years on Twitter, and when I go to follow somebody, I don't follow them just because they've got this big resume. Like the first thing that I see is the content that they provide, the value that they provide, and Larry is one of the most transparent, genuine, authentic people that I've come across, and the value that he's given me is one of the reasons why I'm able to be here with you guys today. The whole concept of less is more, right? Not to have this screen full of 25 indicators, but to just whittle it down, just like a fine piece of sculpture. It's more about what you take away than what you add. And that was a concept that I learned first from Larry. So, really appreciate that, Larry. And
thank you, Michael.
Absolutely. Some of the things that Larry's done, less is more. He's developed a set of exclusionary rules, which I'd love to hear and learn more about, and I'm sure everybody else will as well. Doesn't care about the news. That's another thing that I picked up from Larry, that I don't really trade the news or watch much of it either as far as trading goes. You've been actively trading since '98. Worked with Merrill Lynch, Smith Barney, publishes Blue Chip Daily, and you can follow him on Twitter at LMT978. Larry,
Michael,
thank you for being here, man.
Thank you for having me. I really appreciate it. It's great to be here. Thank you.
So now before we dive in, I just want to give some quick housekeeping stuff too. I should have done this first, but I was so excited to talk to you and get you on and introduce you. Now, so the way that the show is going to work, we're going to go through a set of questions here, go through the interview process, half an hour, 45 minutes or so, and then we will do the live Q&A. Whoever's in the room will be answering all of your questions. If you scroll your mouse around, there is a little Q&A button. You should see it there. Use the Q&A button because that'll allow Larry and I to track the questions. Well, we'll be able to see them, and we'll be able to easily check off what's been answered and what hasn't. As you have questions, put them in. I'll see them. I'll be the moderator for it, and let's get to it.
Awesome.
Let's get to it.
I'm excited. Thank you for having me here.
Absolutely.
Is my camera okay? Because I've got the camera. Am I looking into the camera okay?
Yeah, you look amazing.
I don't want everyone to think.
I love the bull and bear. I love the bookshelf and all the.
My kids got that for me for Father's Day. It's my favorite gift.
Awesome. Yeah. This past year?
Yeah, I just got it 2 weeks ago.
That's great.
Yeah, it's awesome.
Cool. So, can you tell us a little bit about how you? Well, so I know that you started it in '98. What was that like? What even led you to this in the beginning?
It's a long story, and the way that it starts is my family actually worked in a stock brokerage firm. So I grew up when I was from 8 years old. I would go to the stock brokerage firm after school, and I would just see the guys in the offices. They, were wearing nice suits. They had nice cars in the driveway, and it got me interested at first. But then my stepfather gave me Marty Zweig's book. I was probably maybe 16 years old, and he gave me Martin Zweig's book. So I first got interested in stocks then, but then I got away from it, and the market was ripping back in '97. in 98 and I grabbed an IBD and I said, you know what, this is it. It's easy. I'm going to do it. And I had a job that I quit and I went down to the Merrill Lynch office and I said, hey, I'm going to walk in and they're going to hire me on the spot. And the guy wouldn't even talk to me. So they threw my resume in a pile. So it took me a while. It took me probably about 6 weeks to get into Merrill Lynch. And then I started there in 1998. And it was good times. It was a lot of fun.
Yeah, wow. The market was kind of I remember 98 too. I started investing in 98 back then as well, but I had no experience. I barely even knew what the NASDAQ was. I just thought that put money in, more money magically pops out the other end, and learned the hard way in 2002 that that's not quite how it works.
Yeah. Yeah, I learned that way too. So when I first started, picture a day like today, where you've got Tesla up like 5 or 6%, Shopify's up a couple percent. When I started, every single day was like that. So General Electric, Pfizer, Home Depot, I mean, you could buy GE and it would go up 5% a day. So I thought I was a genius because I would buy stocks for clients. I'd say, hey, let's buy, whatever, Home Depot, let's buy Pfizer, Cisco Systems back then, that was the stock. But yeah, it was take a really good day today. And that's what every day was, 98, 99, going into 2000. And then in, I think it was the middle of March or the beginning of April in 2000, that's when the music stopped.
So did you have rules and things like that back then to get you?
No. My rule back then was just pick a symbol and it would go up. And what happened was, so I lost a lot of money it was a lot of money for me back then, but at the end in 2000, when the tech stocks started to unwind, I just chased everything down. So things like JDS Uniphase, Nortel Networks, Cisco Systems, and JDS Uniphase I think was over $1,000. And the only thing that I knew is if it was good at 1,000, it was better at 950. And then I really liked it at 900. And the bottom line is I lost a lot of money. I saw clients lose a lot of money, and not necessarily instructed by me. I would have clients that were, self-directed. And when it was time to sell, they didn't want to sell. And I saw people lose, mid 6 figures. So I didn't figure out any rules really until probably 2005, because what I did, after losing a lot of money, like in Cisco and Nortel and, Sun Microsystems, I wanted to figure out some type of a technical system that would have told me just, get out. And so that's why I started to look at charts and moving averages.
Oh, so back then you weren't even looking at the charts and the moving averages.
No, I didn't really know anything back then. They would have at lunchtime, Merrill would have their top technical guy come on the box and he would, talk some technical things. But I didn't really get into charts and technical analysis probably until maybe 04 or 05. Because I figured out that I couldn't make fundamentals work. So I wanted to find something that was more either rules-based or systematic, or that I could apply to any chart.
Interesting. So well, who would you say is some of your biggest influences as far as charting goes?
It's been a long, so I do trend following. So I don't do traditional technical analysis as far as chart patterns, cup and handle. I don't do Fibonacci, things like that. So I got started reading Michael Covell's books on trend following. And then the person that really helped me out the most was Tom Basso. You probably know Tom, from Twitter. And it's a funny story. I was on Facebook, and I knew who Tom was because I had read about him in Van Tharp's books. And I think I was on Michael Covell's Facebook page because Covell and I were friends. And I saw Tom Basso make a Facebook post. So I said, hey, I know this guy from the book. So I just sent him a message. I didn't know any better. I was pretty naive, right? I'm like, hey, this guy's a famous trader. Let me just send him a message. And surprisingly, Tom answered me back, and we started to develop a conversation, and we're friends to this day. But Tom really pointed me in the right direction of a few key things that I use today.
Awesome, man. I can't wait. I'm chomping at the bit now. Well, what are some of those key things?
Well, the biggest thing, so here's what happened. So I went through the back testing process of, I thought that there was like a magic formula. So I started to get into trend following, and I liked it because moving averages are universal across everything.
Yep.
So I got into back testing, and I said, okay, there's a magic formula that I'm going to find. And after about 6 months, I couldn't find the magic formula. And I was pretty frustrated to the point of where I was going to just stop trying. And I was reading Van Tharp's book. As a matter of fact, it is, so this book, so I don't know if you can see that.
Yep.
And no, I'm not getting, Van Tharp isn't giving me any money. But I was reading that book, and there's a chapter where Tom and Van Tharp did an experiment using a random entry method. So they would flip a coin and then use a 3 ATR stop. And that system was profitable. So it was like a bell went off in my head. It was more like somebody hit me. And I said, if they can be profitable with random entry, just using position sizing, money management, things like that, then maybe it's not the entry signal that's the most important part, and maybe it's all the other components that go into it. So I reached out to Tom. We talked about it for a little bit, and he helped me with a lot of things along the way.
Yeah, the Van Tharp has been one of my biggest influences as well. Like Trade Your Way to Financial Freedom, Super Trader. It was the first book of his that I read and was one of the biggest influences. What were some of your biggest takeaways from Van and from that part of it?
Well, that book, that's easily one of my top 5 books. And the biggest takeaway, so the first thing in the beginning of the book, he talks about that trading is 60% mental, 30% money management, and then only 10% the actual signals that you use. So that was one of the key things. And what I think has helped me the most is to develop the right mindset. So the mindset that I have, and it's different than a lot of what's out there in the media. And sometimes I can be a little bit outspoken on Twitter, but I know that I don't know anything, but I also know that nobody else knows anything. So I watch Bloomberg all day. I have the TV on, and there's a lot of very intelligent people out there, but nobody can really predict the future. So everyone's got a story about, well, this one time I predicted, whatever. But for the most part, we look at the news. If you look at the news today or the news for the past 3 months, the news has been horrible. So the healthcare news has been bad. The economic news has been horrible. Unemployment numbers have been horrible. And the markets, just keeps going up for the most part. Stocks keep going up. So I realized a long time ago that nobody, no matter how smart they sound, they really can't predict anything in the market. So I stopped looking at the news and looking at predictions, and I just focus on what's the market actually doing, because at least that, we have some control over what we do.
But so you mean to tell me that global pandemic, killer bees, riots in the street, and now locusts taking over India, that's not something that would be a catalyst for the market to hit all-time highs?
Well, here's the thing. So you bring up a good point, and I've got to be careful because sometimes people will hear me. And here's the thing. I don't think that the news or the fundamentals don't matter, because I realize that they do. But I don't know that we can always interpret how the market is going to react to that news. There's a saying that even if you knew the news the day before, you don't know how the market is going to react to it. So while I realize that these things are important, it's the only thing that I can really cash is what does the market do. And I've been surprised. I mean, I've had more cash. I've got a higher cash balance for a longer period of time than I've had for a long time based on the volatility. So when the because the VIX is still very high, the ATR and the S&P and these stocks is still very high. So I've got more cash than I usually do. But I've been surprised. Some of these moves that have happened in some of the stocks, like Chipotle. Like when the news first came out, I said, and Chipotle is great. I love the restaurant. But when the news first came out, I said, okay, I'm probably not going to go to an organic, fresh food restaurant and sit down and eat. And the stock's gone from like 400 to 1,000, something like that. So, so some of the moves I think have been, they've been pretty, like Lululemon. I didn't expect, necessarily consumer discretionary, but that's why I stopped really thinking about this. And I just focus on the charts and let the price tell me what to do.
Yep, likewise. But you actually hit on something, and I wanted to see if we could tease it out. It was, so one of the things that I think that you're excellent on, excellent at, is being able to figure out like what's important and what's noise. Right, like, can you speak a little bit to like, because you mentioned that the news is important as it affects the market, but it's so like, how would you start to figure out like, well, what's noise and what's of actual importance to, I guess, your trading or your trading system? Or
so I don't pay attention to almost none of the news. So what'll happen is I have Bloomberg on in the office throughout the day. Most of the time the volume's turned off, but I like to watch, the ticker go across, see what the markets are doing. So I really don't, as far as what news is important, I can't really say that I trade off any of it. I just wait to see what the markets are going to do. So from, I think it's important to know what the Federal Reserve is doing, but at the end of the day, when they first started to ease, the markets were, pump some money into the system, the markets were still going down. So I don't really trade off of any of it, but I look for it as a catalyst.
So it's more an awareness of, is it an awareness of the headlines and then seeing like what the market does thereafter, or
yes. Yeah. Gotcha. So when they announced massive QE, and I think it was the middle to the end of March. So I posted on the Twitter page, on my premium Twitter page, I posted a chart of gold from 2008 and a chart of silver from 2008. And I said the last time they had massive QE, these precious metals went through the roof. So, but I didn't load up on precious metals just because they started to do the QE. I wanted to see the markets actually start to move. So the news might tell us what to be on the lookout for, but I'm still going to wait for the chart to confirm it before I do anything.
Silver actually taught me how to manage risk and to set going away plans for your portfolio. If I could share a quick story with you.
Sure.
So back in 2011, silver was ripping. And I had a position, I had a good sized position, and I thought that that I had finally turned the proverbial corner in my trading. I was trading for 10 years at that point, and I was finally starting to get a little bit of consistency, and I was getting married that year. And so the wedding was April 30th. And right after that, went on my honeymoon. And if you were to look at a chart of silver, back then, like you would have seen the top like right then. And then as I was away, that's when silver collapsed. And I came back, I was up probably about 70%. I came back to about being up 7%. Wow. And it was like, well, what happened? I thought that I said, Stas, whatever. Nope. So that taught me a very important lesson, to make sure that you double check your stops and all that stuff.
Silver's a very volatile market too. I mean, of all the markets, I mean, silver is super volatile. But yeah, I mean, and now today, it's it can be from the morning to the afternoon. As far as how the moves, I've got to say, the moves today are pretty fast. Some of these pullbacks that I think used to take place in a couple weeks or a couple months take place in a couple days now. I mean, these are some pretty sharp moves.
Yeah, like it's It's intense. Well, why do you think that is? Why? Well, like, is there, like, is it just like is what it is, or do you
I
have
think
like,
from what I read, so from what I read, 80% plus of the trading these days is automated. It's either computers, some type of automated system. So I just think that, before where, when the markets were mostly people, sometimes it might take us a lot longer to process. Plus there's the news flow. I mean, there's no, in the old days, you might have to, like, if something happened in the Chinese markets overnight, they might have to wait until the next morning to hear it. And now today, I mean, especially with Twitter and social media, I mean, everything is instant. So I think the fact that the news flow is so fast and there's so many automated systems that are in the market, I think that contributes to it.
mm. Is that part of the reason why your focus is on blue chips and on you trade ETFs as well?
I trade mostly stocks, some ETFs, probably 80% large caps. So I'm in some of the big names like Amazon, Microsoft, Shopify, things like that. I'll look every so often to the mid caps, but I'd say it's probably 80 to 90% large caps. But they can move too. I mean, Square's been a big mover. Amazon's been a big mover. So yeah, but I lean towards the large caps and the mega caps.
It is one of the benefits of doing that you have like less overnight risk, less volatility, like that versus some of the small names out. Like, of course, like it could do anything at any time, but is that something that you've noticed is less?
They're a little bit less volatile. But they still have some volatility. But yeah, they're a little bit less volatile. Like, I don't want to get caught up in a small cap stock and then wake up tomorrow and it's down 20% before I even have a chance to do anything. Now that can happen with large caps too. But I think I've been more comfortable for a long time trading in the bigger names, the higher volume names, institutional names that are doing 10 million, 20 million, 30 million shares a day. I'm just more comfortable in those more liquid stocks. And it's a lot easier to get a position too, if you're trying to put some money into it. But that's, they can move just as fast. If you look at some of these moves in the large caps, they can move pretty fast.
Yeah, like we were talking about, Shopify, right? Like,
yeah,
geez,
yeah.
like,
Shopify's been a mover. Well, the other thing is I want to be able to get some money into it. And so I use volatility-based position sizing. So for these more volatile stocks, I might not be able to get enough of a position in there for it to make sense. Like, I don't use the triple levered ETFs. So like if I want GDX, I'm just going to put money into GDX, because the way that I manage my positions is if whatever the volatility is for GDX, let's say 5%, average daily range is 5%. Well, for the triple levered ETF, the volatility is going to be 3 times as high, so it's going to be 15%. So the way that I manage my positions, I would only be able to put 1/3 as much money into the triple levered ETF as I could put into GDX. So for me, it's the same whether I put 3 times as much in the lower volatility or 1/3 as much in the higher volatility. So I stay away. If I were day trading, then I would use, the triple levered ETFs because they can move pretty fast. But for what my time frame is, the single levered ETFs are fine.
And your time frame is generally?
So I call it intermediate to longer term. So I'll hold a position for the most part as long as it's working, as long as it doesn't, go stale on me. But I mean, I can hold positions. I can be in positions for over a year. My average winner, I hold for about 8 months. Now some people are going to hear that and probably fall asleep, when I say that, but you can make a lot of money. If you look at some of these big moves, and it's like what you and I were talking about before, the way that I came about this is 15 years ago, I'd buy a stock. I'd buy $100 stock. It would go up $2. I'd sell it, feel like I was a hero. And then I'd look at it 3 or 6 months later, it would be $150. And I said, well, why was I so fast to sell it after making 2%? So, and plus what my time frame is, I'm looking for big trades. I'm looking for big winners. And I think that's, I want to get in the chart. When we look at a chart and it's in the upper right-hand corner, I want to have bought it in the bottom left-hand corner, but you can't do that if you sell them too fast. So now I'll trade ETFs much shorter term. So I might swing trade ETFs, triple Q or something like that. But 90% of what I do is going to be my intermediate to longer term. Every time I deviate, I tend to not do as well.
All right. Are you actively testing any other strategies, or is it
Not right,
what would
no.
cause you to deviate?
Not really. No, I'm not. What happens is I've gotten to be, I think, really proficient at what I do, which are the programs that I trade. So I really focus on two things, pullbacks and breakouts. And that's about it. And what I found is once it works and I'm comfortable with it, I don't want to, at this point, I'm just not looking to do anything else. I think part of the reason is because I'm at a point where the returns that I'm getting, I'm very happy with. And, it's just kind of where I'm comfortable with it.
Do you still have stock charts up? Are you able to share one of the pullbacks or breakouts, so that way we can see an example?
Yeah, you want me to go to share screen?
Yes. Yep.
Okay, so we'll go to share screen. So share, and then so we'll take a look at one. So we'll take a look just off the top of my head. So Amazon is a position that I've been in for a couple months. So I got into Amazon. So I think it was April 6th, April 7th, something like that. But if I look on the chart, it's going to be, if you can see where my cursor is, it's this daily bar right here. So I just took Amazon simply just coming over the 50-day moving average. And then as the stock started to work, I've held on to it, but it was pretty simple. So this was a breakout. I took square with, this is probably the easier one to visualize. So I took square right after earnings coming over the 200-day moving average. So I think it was this bar or this bar. I couldn't tell you exactly which one. I'd have to take a look at my records, but it was pretty simple. So it was a stock that I track. It broke out over the 200-day moving average. They reported earnings. So what the signal was for me was the break over the 200-day moving average, but I had to wait until they actually reported earnings, because it seems that, when I try to go in ahead of earnings, oftentimes it's a pretty dicey strategy. I'll hold a stock through earnings. So if I have a position already established, I'll hold the stock through earnings, but I don't like to buy a stock, a day or two before earnings, because it's a gamble.
And how much of a profit cushion do you need to hold through earnings? Or is that a factor? Or
it's not really much of a factor. If the stock's working, the only time I'd really start to worry about it is if the stock was trending down into earnings. Then I might. So if let's say I bought the stock here and it starts trending down into earnings, then there's a good chance that I'll cut half the position or all of the position, because I do believe, and I could be wrong, but I believe that the market tends to move ahead of the news. And oftentimes when you see these big gap ups after earnings, you'll see the stock's been moving going into earnings. So the only time that I would really consider cutting a position into earnings is if I were underwater or it was acting very, very weak going into the earnings. I'd probably cut at least half the position.
Interesting. And when you're, I feel like, you mentioned it earlier, but as far as sizing goes, right? You were, how exactly are you sizing?
I'll generally start the position anywhere from 3 to 5% right now based on volatility. So when the market's a lot quieter, and I'll give you an idea of what I mean. So if we take a look, we'll take a look at the SPY chart for a second. and then we'll go down to, so ATR, which is the average true range. This is something that I use pretty consistently. So if you take a look on the SPY chart, so the ATR, which is the daily range, traded about $2 to $3 for quite a long period of time, maybe under $4. But then it broke out to 15. So what this says is that at this point, the market is 4 times as volatile as it was down here. And even right here at $6.68 versus, let's call it $3 at the top, the market is still twice as volatile on a daily basis. So when volatility is low, I'll take much bigger positions, maybe, 5, 6, 7, 8% to start, maybe 10%. But when the volatility is as high as it's been, my positions are generally going to start 3 to 5%.
And that's 3 to 5% of the total
of my
available
assets.
capital. Yeah, that's
of my total account. So I'll run anywhere. So I had no positions in, I got stopped out and I just went to cash in March. But I'll generally run 10 to 15 positions in a market like this. And then if we get back into this, so if we get back to where the VIX comes down into the teens, where this ATR comes down, and things are not as volatile, then I'll go north of 20 positions sometimes, and I'll go on to margin. But right now, I think I've got 14 or 15 open positions.
Interesting. Okay. All right. I saw a lot of questions start to roll in when as we started to bring in the chart. So I'm just starting.
I like charts.
Yeah, me too. It's like it's like reading an EKG, right?
Yeah.
Like I think of us as doctors, and this is how we're seeing how the patient is behaving, or more like brainwaves of the market.
Yeah, the charts tell a good story.
Someone was asking about day trading that you mentioned day trading earlier.
No, so swing trading every so often. So I don't do any day trading because it's just not, I really wasn't that good at it. So every so often I'll trade ETFs in a shorter term time period. Maybe I'll hold it for a week or two, but I haven't done too much of that recently. I've been more focused ever since the market unwound in February and March, and then it started to recover. I've just been more focused for the most part on building some longer term positions. Because I think that if the move at least stabilizes, so if the market is flat to up, and I think there's a lot of these stocks, that could turn into some pretty big winners. Now, if the bottom falls out like it did February or March, then it's tough to do. But I think that if the market just kind of stays stable, there's some really nice longer term winners to get. So that's more what I'm focused on.
A question came in from Chet. What do you look for to expand and contract your number of positions? He said that he always finds himself fully invested when the market is about to roll over.
Yeah, that could happen too. So what I do to manage risk, there's a couple things. I look at what my open positions are doing before I start to add more risk. So if I start to take positions and they start to go underwater, then I don't add more risk. So what I did, I started to buy back in on March the 18th with with XLK. So XLK started to work, and then I added Microsoft, I think 8 days later, and then that started to work. So as my positions started to work and as the market started to stabilize, I added more risk. But what I do constantly, so I scale some profits. So today I scaled some Shopify. I'm up 20% in my Shopify position, so I dialed some back. Square hit a certain target yesterday, so I dialed some back there. So what I've learned to do is to scale some profits and take some profits on the way up. And I also
is all that pre-planned?
What's that?
Is all that pre-planned?
Yeah. So what I do for the website, because I've got members that belong to my website. And what I wanted to do is put together something consistent that everyone could easily follow along. So at 20% I scale a certain piece out of the position. And then for every 10% increment, 30%, 40%, 50%. And what it does is it makes it a little more systematic. So we just know if a stock hits 40%, I'm dialing, X percentage out of the position. And this way there's a lot more consistency, but I'm still holding the bulk of the position. But so I take profits, I raise my stops, I make sure my open positions are working. So I've got 14 or 15 open positions right now, and I think one is underwater. So all the other ones are profitable. So I took a position on Friday in a software name on a pullback, and I'm looking at the screen now. So it's down like $1.60. So no big deal. But what I want to do is I want to see my positions working before I start to take on more risk. But then what I'll do is take profits, raise the stop. So I'm not just, buying stocks here and then they go up and I don't, take any profits along the way. So it's constant money management. But yeah, when volatility comes down, I've got much more exposure today than I had 3 months ago.
Let me ask you this, because learning how to sell into strength was very challenging for me. Eventually I did it. Did you find it challenging to take profits along the way, or was that not something that was challenging to you?
Yes. Yeah. The exits can be the more difficult part. And that's why I have found that by scaling, scaling to me is the best thing that you can do as a longer term trader or investor, because here's why. So I've got, we'll just take a stock, we'll say Square. So, and it's a very nice uptrend, but tomorrow, and we've seen this before, tomorrow this could be the top and then everything can unwind. So I don't want to get into a position, because I've had this happen before, where you're up, 20, 30% in a stock, and then for whatever reason, it comes back down. So what I found is that by the best thing for me was to make it systematic with the fixed percentages, because then, if I sell some Square up here, I want it to keep going. Would be hard for me, it would be hard for me if I bought it here and then I sold the entire position right here, and then I saw it go up, 30 or 40%. And that's why, but I'm comfortable with only scaling a piece of it. And then if it comes back down, like I had Exxon Mobil, and Exxon was up at one point 32%. I scaled some of it at 20%. It went up 32%, and then it came back down, and I think I sold out of it, and it was up maybe, 6 or 8%. So that's, part of what I do is I realize that in order to catch these bigger moves for my time frame, I'm going to give some money back, and I'm okay with that, because I'd rather give some back of a small move than miss out on a really big move.
Is there a certain percentage where it would rise to that you would have sold the whole thing, or are you selling that last bit into weakness?
I'm going to sell the last bit into weakness. I'm going to hold it, because I believe, with trend following, I believe the only way that you can catch the entire move is you're going to give some back at the end, and I'd rather give some back at the end and catch the whole move on the way up than try to get out of it too early. So I'm comfortable giving some back at the end.
Roughly, like, how much of the position are you letting go along the way? Like, this is something that I'm actually working on back testing myself right now.
Yeah, I'll generally scale about 10% at every 10% increment. So in a case like this, if Square's up 20% and I take 20% out, and it goes up 30%, and I take another 10% out. So technically, if I catch a big winner, if the stock's up 50%, I might have taken 30 or 40% or 50% of my original capital out of the position. So that's how I manage the risk.
All right, and then the remainder would be if it breaks a certain
then I've got thresholds that I use as far as price levels and moving averages to determine the final exit, and that's going to vary based on the chart.
Very interesting. Yeah, it's almost like flying a kite, right? Like at the
Yeah.
beginning, like you're holding it real tight, and then as it gets to go, like you give it more and more slack.
We never know where these are going to go. You just never know where these stocks are going to go. And the only way, for me, the only way to catch the really, really big, because, one or two trades can make your entire year. It really can. And if you get the right one, it could make more than your year. So, I think what really, got this into my mind was a couple years ago. I don't know if you remember when NVIDIA took off, and I talked to quite a few people. So I've got NVIDIA, but I talked to quite a few people. So NVIDIA did nothing forever, and then it started to break out. And I think I heard more stories online of people that bought NVIDIA at 20 and sold it at 24 and then watched it to go to 280. And to me, I would much rather, get stopped out of a position. So the way that I manage my positions is I'll risk 0.5% to 1% of my capital. Risk, not position size. So I might put 4 or 5% in the position, but if I buy a stock and I get stopped out, it's going to cost me 0.5% to 1% of my entire account, which, you can live with that. You could lose, 100 to 200 times in a row before you go broke. So 0.5% to 1% if I get stopped out. I would much rather get stopped out and give back 0.5% or 1% of my capital than watch a stock go from, 25 to 250 that I sold. You see what I mean? So that's why I'm comfortable. At the end of the day, I've got a much higher than 50% accuracy rate. But even if you just have a 50% win rate, if you make $1.50 for every dollar that you lose over time, you're still going to make money. So that's why, you know what, if I keep my losses, so right now my stops, and I run much wider than average stops right now. So right now my stops are somewhere in the 10 to 15% neighborhood. They'll generally run.
And is that when you're starting a brand new position, your stop is 10 to 15%?
Correct. Exactly right. Okay. So if I put 4% of my capital into a position and I've got a 15% stop, then I'm only risking 60 basis points of my capital. You see what I mean? So I would much rather, because I trade some, higher volatility stocks, even though they're large caps, but I would much rather give back that 0.5% than watch a stock go up, 3 or 4 or 500% that I sold too early. It's for me, it's hard to completely exit a position that's working. It's okay to scale some, it's okay to take some profits, but it's hard for me to, say, okay, I think this stock has gone up too much and I'm just going to sell it. That's, I want to go with strength and go with the trend.
How did you find that out about yourself?
What's that? I lost a lot. I lost a lot of money. For me, everything was trial and error. And what I had to do was I had to make mistakes and I had to lose money. And I finally got to the point where I said, okay, well, I'm tired of losing money. Because I washed out of trading probably 2 or 3 times. Between 1998 and 2007, I probably walked away from trading, 2 or 3 times because I hadn't figured it out yet in my head. And then I just got to the point where I said, okay, I'm tired of doing it the wrong way, and I'm tired of making the same mistakes. So I learned what worked for me. Now, what works for me won't necessarily work for the next person and vice versa, because, everyone has a different mindset, a different risk tolerance. And that's great. There's no right or wrong. It's just what works for each person. So some people might hear the way that, that I trade and think it's pretty boring. And, because people want to, sometimes they want the quicker gratification. There's nothing wrong with that. I've got nothing against day trading whatsoever, nothing against swing trading. I think everyone should do what works best for them. But for me, what I do works best for me.
Absolutely. Yeah. It comes down to what's your goal? What are you able to execute? And what helps produce the kind of lifestyle that you want?
Mm-hmm. Yeah, I just wanted to do something. So I just wanted to trade in a way that, you see, we all have a personality. So some of us are very outgoing. Some of us are very introverted. Some of us like to go to parties all the time. Some of us like to, you know, sit on a boat all the time, whatever it is. So with the markets, you know, the markets are the same for everyone. The chart that's on the screen right now is the same for everyone that's watching this video right now. But what we do with it is different for everyone. So I just had to figure out, you know, I had to find myself in the market. And then once I did, things got a lot simpler for me. But it took it took probably, I would say, 10 years before I figured out what worked, you know, what worked for me. It took me probably 10 years.
Wow, I love you even more with that statement. I thought that I was the only person that was at 10 years before like things started to click. That's beautiful,
through,
man.
I did it all. I did day trading. I did options. I did, name it, I did it. You know, biotech, whatever, micro cap stocks. And I walked away, and then I came back, and then I walked away. And then, you know what really did it for me? True story. And this comes up a lot. So this book, because I know we've got people that are listening. So the Jesse.
Oh, we can't. Can you stop sharing the screen for a second so we can see?
Oh, yeah. I got to stop sharing the screen. Hold on. Okay,
there we go.
This book. Can you see it?
Yes. Classic.
So this was, so somewhere in this book, and I think I probably got it highlighted. So right here, if you can see that. So it's on page 100, it's page 56 and 57. So basically what he says in the book was that, and this is what I remember reading it, and it was like just a brick. So basically what he says in the book is that, and keep in mind, this is Jesse Livermore's opinion. It doesn't have to be everyone's opinion. But what he said, that he found that the most money was made not in trying to catch the day-to-day and every you know move, but the most money was made by catching the big move. So if you see that a bull market's starting, get in and hold on. Don't try to trade in and out. And once I read that, it was like relief, because I used to think that I was doing it wrong. And I used to think that you just had to, you know, buy it in the morning. And if you were, you know, up by whatever, 50 cents, sell it. And that's what trading was. And then you went on to the next thing, and you went on to the next thing. And I wasn't really very good at that. So once I read someone else say, hey, you know, the big money is made in the big swings, that's when I said, hey, well, maybe there's hope for me yet. And I think that really set in like 05 or 06, something like that. And then it still took me some time to figure out, you know, what was gonna, you know, what type of technical system was gonna work for me.
That's great. So many gems in that. So somebody else was asking too, the other Van Tharp. No.
Oh yeah, the Van Tharp book. So this one, I don't know if everyone can see that. So Trade Your Way to Financial Freedom. Really, really good book. And Tom Basso is in there quite a bit. And the Van Tharp book is good because it's about mindset and trading. Really, at the end of the day, some people say trading is 60% mental. Some people say it's 100% mental. It's a big number, because the fact of the matter is, you could know what a stock was going to close. You could know the closing price of tomorrow right now and still mismanage the trade. You see what I mean? So if I told you, whatever, you know, XYZ stock is $100 now, and it's going to close tomorrow at 105. There might still be people that try to trade it in between 100 and 105 and wind up losing money. So it really comes down to you have to adopt the right mindset.
100% agree. Yeah, like I believe Tharp, I believe he had said that trading is 100% mindset, because we don't trade the market, we only trade our beliefs about the market.
Right. That's exactly right. Yeah, we don't trade the markets, we trade our beliefs. That's exactly what he said. Yeah, so
that's something that guides me and has stuck with me many years as well.
It's true.
We had some other questions about some of the charts that people were asking.
We go back to screen share.
Yeah. This question came in from Josh. He wants to ask how you execute on a pullback within an uptrend. Are you waiting for the price to pull back to a specific level, or no? Well, what triggers it?
My favorite's a pullback into a moving average. So really, once you identify, and we could just use triple Q. So once you identify that there's some type of an uptrend, you know, any type of a pullback, especially a pullback into the moving average, that would be ideal. So to give you an idea, so this is a chart. So I don't have a position in this, and the thing is, I can't take positions in every single. I wish I could, in every single chart or every single stock that shows up on my screen, because it would just physically be impossible. But so for example, so eBay is a position. So I made this the chart of the day on my website for subscribers last week. And then I do a chart of the week email, and I sent this out. But it was just a very simple example was eBay broke out, and then it just pulled back right into this 20-day moving average. So, you know, this is an ideal setup. Nice breakout, sideways consolidation. And then what I'd look for here is I would use this moving average and look for consolidation to the upside. Do you see what I mean?
Mm.
So that would be ideal. You know, one that's on my radar right now, you know, just as an example. So Team, Altasian, so it had a breakout and then it's pulled back into the rising 50-day moving average. So what I do, this consolidation right here into the rising 50-day moving average. So I'm just going to bet on, I'm going to look for trend continuation and look for this moving average to provide support and then move to the upside.
And so what would be your signal that the trend is continuing? A break above 187.71 or like where that's marked there?
Yeah,
or
that's a good question. So so someone who's more active would take the position right here just based on the consolidation, and then someone who's waiting for a breakout, you know, over 185, you know, I would say over 185 would signal a breakout. So there's really two types of traders. Some people are okay buying it here, because a lot of people, keep in mind, a lot of people have difficulty buying a breakout because they feel that they're chasing the stock. You know, some people have the mindset that if the stock was, you know, $75 today and it's $80 tomorrow, they feel like they've missed it, which is not, you know, and I see that online, you know, when a stock starts to go up, people will say, well, I don't want to chase it. Well, you're not, you know, I don't know that you're really chasing it if you're following the price breakout, you know. But so on this type of consolidation, if this were on the radar screen right now, you know, you can use a buy stop order. Let's say, you know, as a trader, you say, okay, this is consolidating and I don't see anything right now, but if it breaks out over 185 or 187, whatever your number is, you can put an order in the system. You can put an order to buy, you know, the stock at 185 and change, and it's like a stop order in reverse. If the stock doesn't hit 185, your order doesn't get filled. And if it does hit 185, so that's, you know, a good way to catch breakouts for breakout traders is to use a buy stop above the market. Because there's some traders that will look at this and say, you know, this doesn't offer them anything whatsoever. But if it breaks out over 185, then they'd be interested. And that makes perfect sense. You know, you could look at it both ways.
I have a question about buy stops versus buy stop limits. Which do you use and why? I
use buy stops. And the reason I don't use, so when I want to get out of a position, so let's say I took this and my stop loss, we'll just use a hypothetical number. Let's say my stop loss is right here. I'm going to use a stop loss at the market. So if it hits that number, it's going to fill. So if I had a buy order here, let's call it 187. I'm going to put in a buy stop at the market. So if it hits 187, it's automatically going to fill. I don't like to use limit orders to get into a position because you might miss the entry. See, if you put in a buy stop at 185 with a limit of 185 and a quarter and it goes to 186, you never get filled. So if I'm looking to either get in or use a stop loss down below, I'm just going to use a stop and then let it convert to a market order.
One of the challenges that I find, well, with just using a buy stop is, well, what if price gaps up and you were intending to buy a certain number of shares based off of getting in closer to 185, but instead price opens at 190 and you're filled at that
you're
position.
filled. Then you're in. That is the one drawback. And it's the same thing with if you use a limit order below. So let's say the stock is trading at 180 and you decide if it goes to 170. So you can put an order in the system to buy it at 170 and then it gaps down to 155 and you get filled. So that is the drawback of having orders in the system is you might get filled at a price that's not ideal.
So when that happens, well, what do you do?
You've got to make a decision. There's a couple things you can do. If you don't want the stock, you just get rid of it and get out of it, or you can reduce your position size. So if you had a plan to buy 100 at 185 and then it gaps up and you get filled at 195, you could cut your position from 100 shares to, let's say, 90 shares. You see what I mean?
Okay.
So if it went up past your original buy point, you could just reduce your position size to get back in line. But I mean, if you have an order to buy it at 185 and it goes to 190, it's that's good. Stock's going up.
Interesting. All right. Cool. Thank you.
Sure.
Yeah, I'm adding that to my repertoire. The way my solution to it was to use the buy stop limit, but to have the limit not be at like 185 and a quarter, but to say like maybe 187 and position size that way. And like if that works too. So this way, if it gaps to 190, you're not going to get filled whatsoever. Yeah, exactly.
So if it gaps over one. Yeah, I mean, there's no perfect formula. It's like with stop losses. It's like, if I've got a stop loss at 160 and the stock gaps down to 155, and then someone says to you, well, that didn't work out. Yeah, it happens. I mean, it's the market. Anything there's no guarantees. But yeah, what you said makes perfect sense. If you've got a limit, order, you won't get filled over a certain price.
Let's see. How does Larry handle when his stocks are basing? This question is from Michael. As this can take 2 months or longer, whilst they are still in the trend, do you feel the need to sell positions for entering new stocks that seem to be starting a new move?
Yes. So what will happen is, and that's a good question. So what will happen is at times stocks, and I've got 2 or 3 names right now that I'm looking at that, they're working, but they're working very slowly. And I've got other stocks on my screen that I think are going to offer me a better risk reward. So that's a decision that you have to make. But yeah, I recently cut, I had a department store stock that was, I got into it because the chart was set up very well. It just didn't have the movement that I was looking for. And there was what's that?
Okay.
And there was a software stock that was on my screen that was set up well. So even though the department store stock was trending higher, and I sold it a little bit over break even. But yeah, and I've got a couple stocks right now that, they're working, but there's other charts that are on my screen that I think offer me a better risk reward. And there's a good chance that I might cut those positions. I just cut, I cut Exxon. Exxon was profitable, but I see other opportunities on my screen that are, that are better, that I think are better than Exxon. So we'll see. But yeah, sometimes you have to cut the stragglers if you're looking for better performance.
Well, what would signify a straggler to you?
Relative underperformance. So if I've got a stock, we'll say semiconductors. So if I'm holding a semiconductor stock and all the semi stocks are going up pretty sharply, and I'm sitting in the one that's going down to going sideways, then you have to make a decision. Why is there a weak relative strength in this stock? What I want to do is I want to get into the strongest stocks in the strongest sectors that I can. And sometimes stocks like AMD, you know, AMD has been a stock that has surprised me because AMD is normally a very high octane stock. AMD is normally a very, very strong stock. But if you take a look at AMD at 52.61, AMD is the same price today that it was in January. And if you look at this trading range here from April until now, AMD is flat. And then if you take a look at a stock like NVIDIA, so you see where NVIDIA is from 300 to 380. So for whatever reason, AMD is underperforming. It is. And if I were sitting in AMD, which I'm not, but you have to make a decision. If you're sitting in an AMD, when it goes, it can go pretty quickly. But if you're sitting in AMD and you're watching NVIDIA, and then today Lam Research had a really nice breakout, and then, you know, if you're seeing all the other semiconductor stocks do this, and you're sitting in one that's down here, you have to make a decision based on the relative underperformance and relative strength and say, okay, you know, and listen, there's no 100% formula. You might get out of AMD and go into Lam Research, and the day that you sell it, AMD goes through the roof. There's no 1000% magic formula that works all the time, but you just have to make a decision. If you're looking for relative strength, you know, if you're sitting in this stock when the other stocks are trending higher, you know, you have to make a decision if you want to stay in that laggard or not.
Well, one solution that I've used for that, and I'm curious to hear your thoughts on it, is to use the moving averages as trailing stops, and
Sure.
to use like to scale out based on trailing stops. So like I'm a little bit shorter term than you are, but like I'll use typically like the 5, the 10, and the 21 as my trails. And then like if it's a really strong performer, like maybe it'll even get down to the 50, so we'll see what Tesla does, but so far Tesla's been holding the 21 very well.
Yeah. And I think I love moving averages because the thing about moving averages is they're not subjective. So if you're trading a position, so you mentioned Tesla. So if you're in Tesla and you say, and you know, so I use the 20-day, but if you're in Tesla and you say, I'm gonna hold this stock until it closes below the 20-day moving average or the 21-day or the 50-day, whatever it is, then there's really nothing else for you to do other than just manage that exit. And that's the nice thing about moving averages, because if you look at this stock, you could, you know, 50 different traders could find 50 different chart patterns in this stock. You know, 25 would be bullish and 25 would be bearish. But if you're using moving averages, it's if I had this and I said, okay, I'm going to hold it until it closes below the 50-day moving average. That's it. That's, you know, what else is there for you to do? You know, so averages aren't perfect, and you know, half the world thinks that moving averages aren't even really a thing, and that's fine. But there is nothing that's perfect. But the nice thing about moving averages is they're tangible, they're not subjective, and it's either over the moving average or under the moving average.
Yeah, keep it simple.
Yeah.
I believe you mentioned this before, but we got a question about options. If you use options at all to manage your risk or to help manage stops.
I don't, and I've got nothing against options. I just don't use them because the times I'm not very proficient with them, but the times that I would use them in the past, they didn't do what I wanted them to do. And that was probably my fault because I didn't buy the right options because I didn't know what I was doing. But, you know, there were times before where I buy put options. And like I said, it's my fault. It's not the options fault, right? But I'd buy put options and the stock would go down and my options wouldn't move. Or I'd buy call options and the stock would go up and my options would go down. So I didn't want to put the time into it that is probably necessary to learn how to get proficient at it. I just wanted to focus on what I do. So I've got nothing against options whatsoever. I know that, you know, you can make a lot of money if you do it right, but it's just not something that I've gotten into.
Fair enough. Question from Scott. What other traders do you recommend following?
Wow. That's tough
already
to say.
mentioned
So
Tom
like on Twitter?
Sure. Twitter or other people that like I would throw that into like you already mentioned Tom, you already mentioned Van. I don't think that Van is very active on social media.
He's not. Tom isn't very active either. It's tough to say. I can't really say traders. I could say more, books, but I couldn't really say traders, because if I say that I think that, XYZ person is someone worth following, and then you follow them and blow up, then I'm the bad guy. You know what I mean? So I mean, I follow quite a few people on my Twitter feed, just because I like to have some variety that's on there. But I couldn't, really, probably Tom's probably my favorite.
Awesome.
And it's based on time frames too. There's a lot of traders on Twitter that are much shorter term swing traders. You know what I mean? So probably someone, you see, if you say one person, it's like when you have kids. If you have 5 kids and you buy one of them ice cream, you have to buy the other 4 ice cream. So if I say who I think, the good ones are out there, the ones that you don't mention, Michael Lamoth might get mad at me if I don't say you, but
he'll find you and hunt you down.
Yeah, take a look. I'd say go through my Twitter feed. There's probably some good people on there.
Awesome. Andy says, what is the criteria that Larry uses to have a stock go on his watch list? What are some of the criteria that you use?
So I do a nightly technical scan. So the first thing I look for, so I start my scan with large caps. So I just go into FinViz, $10 billion and higher is the first thing that I look for. I filter out certain industries. So for the most part, I don't do anything with utilities. I don't do anything with consumer staples. I don't do anything with REITs. And then I run screeners based on relative strength and price performance. And then I run a separate screen for mid caps, because I've started to get more interested in mid caps, the $2 to $10 billion price range, because I think that, Shopify is great, but Shopify is a $100 billion stock. So at one point, Shopify was maybe a $5 billion stock. So I've gone more into looking at some mid cap ideas in the 2 to 10 billion, but I start with market cap. The next thing I look for is what industry they're in. Also, I want some liquidity. So for the most part, so like I don't go into these unprofitable biotechs, but I generally like to see stocks that do at least 1 million shares a day. It doesn't mean that I won't go under that, but I like to see some liquidity and some institutional support.
Interesting. Well, why is liquidity, or why is that level of liquidity important to you?
I found that you avoid a lot of the gaps and avoid a lot of the big surprise. So if you get into these thinner stocks, if you get into these really thin stocks, they might gap down one day 25%. And I'm not looking for that. I'm more comfortable. Like I say, even in a stock like Tesla, 16 million shares, I'm looking for the higher volume names. It's just there's some people that are the opposite. I've got friends that only want small caps, or they only want, the thinly traded stocks, and that's what works for their, for their personality. But I like the big names.
Question from Michael, for getting into a new position, do you wait until after the market is opened? And do you, I would say for the same thing for the exit, are you waiting until the close of the day or the week, or well?
No, so when so for example, today I scaled some Shopify. So what I did was I put in an order in the system. So I used a sell limit order, and as soon as it hits it, it hits it. When I use stop losses, I've got hard stops that are in the system. So if I've got a stop at $80 and the stock hits $80, whether it's 9:30 or noon or 2 p.m., whatever it is, it's going to get filled right away. As far as the entries, I'll take the entries when I get the signal. I generally am not going to, wait until the close to close out a position. If it hits it, it hits it.
And this is a good question from Josh as well. I think a lot of people struggle with this one. How did you develop? And then for me, a follow-up question, how do you think other individuals can develop sitting power, the ability to sit on your hands?
It's a good question. The first way that I learned it was, and I remember it because I told myself I was going to practice it. So I don't know, it was probably 13 years ago. And I bought a stock, I think it was like Alcoa or something like that, US Steel or something like that. And it went up whatever, like 2 or 3%. I was like, okay, I've got to sell it because I made 2%. And what I told myself was, instead of selling all of it, I think I put like 10 grand into the position. And I told myself, I said, what I'm going to do is I'm going to leave just $1,000 in the position that I don't even care about. And I'm just going to let it go. And so the way that I learned the sitting power was, in the past, when I was just going to take that profit right away, I said, okay, I'm going to leave just a little trailer in the position and see what it does. And then what you see, because what happens is we all, we have the fear of giving that money back. The reason that people sell stocks too soon, I think, is because we think, I'm going to give that money back. And the interesting thing is that people often take their winners a lot faster than their losers. We hear the fact, people get into a loser and it starts to go down. And then you hear, the old saying that I used to hear, well, it's not a loser until you sell it. Well, it really is a loser, if it's a loser. So often people will sit with their losers because they don't want to take that loss. But then as soon as the winners go up, they want to get that profit, so they don't give it back. So the way that I learned the sitting power was to consciously tell myself, I'm going to leave just enough in this stock, so where, I'm not going to miss it, set the stop at break even. And once I saw how the stock started to progress, I got better and better at, but I had to make a conscious decision that I was going to experiment with, holding it for a longer period of time. And the simplest thing I know to do is you get a winner, set the stop at break even, and then let it go. Because this way you can't really lose any of your original capital if your stop's at break even for the most part.
So when you're telling yourself this, are you waking up and before the market opens, you're looking at yourself in the mirror and you're telling yourself this? Is it something that you're writing down in a journal? If you're writing it down in a journal, is it something that you're writing down every day, or do you have it in a how are you telling yourself?
Not anymore, but I used to have to write it down. So what I did was, when I first put together my rules-based system, it was I sent an email to myself. And it was probably like 20 rules, right? And I used to have to read it before every day. And I made a checklist for myself. And before I could buy a stock, I would have to fill out this checklist, right? Is it over this moving average? How much volume does it do? Because I used to just want to buy everything. So now it's just ingrained because I've been doing it for a very long time. But at the time, I used to have to write things down. And before I could take a position, I would make myself fill out this checklist. And then when I sold it, I would have to fill it out. Like, I had to put it in writing because I used to overtrade quite a bit.
How long do you think that it took you to build that habit?
Once I would say, once I got to it, it probably took me probably like 6 months. Once, because I got to a point where I told myself, I said, I'm either, and I think it was coming out of the low in 2008. I said to myself, I'm gonna get it right this time, or I'm just gonna go do something else. Because I figured after 10 years, from 98 to 08, if it wasn't working, maybe sometimes you're just not meant to throw the football. Maybe you should hit the baseball. But once I got really serious and told myself it's either gonna work or I'm gonna get out, it took me probably 6 months, and then it was a constant process. But but yeah, once you just have to get tired of doing it the way that's not working.
Question from Dave. He likes the checklist idea. Can you share what some of the stuff that's on it, and do you have a selling checklist?
Well, I don't use any of that now. So I just have a spreadsheet I don't have checklist or any of that now, because I've been doing it for so long that I just know the process, hands down. But when I first started, and, when I was using the checklist, this was probably 2006, 2007, 2008, in that time period. And, it was just simple. It was just a lot of basic things. like, you know, I'd have to write down the stock and the price, and I was using moving averages. So, you know, is it over the 50-day moving average? I'd have to write yes or no. Is it over the 200-day moving average? I'd have to write yes or no. And then I'd have to write down, you know, why I was buying the stock. If there was a technical signal, you know, was it based on an RSI break, whatever it was. So so that was the way that I got myself into using rules. And then over time, it's, you know, I've stopped doing it because I just have the process down pat. But I do use a pretty detailed spreadsheet. So I've got.
Is that something you developed yourself, or something that you?
I share it on my website, so all my members see it. So when I take a position, so you know, if I buy a stock right away, the entry price goes on, the stop level price goes on, how much risk I've got in the position, how much volatility is in the position right away. That all goes onto the spreadsheet. So everything gets tracked right away. So I track all the performance of not only my stocks, but every day I do a chart of the day idea. So every day, the chart of the day. So, you know, the chart of the day today was a semiconductor stock. As soon as I announce it, I put it on Twitter, I put it on the website, and then it goes right into the spreadsheet. You know, here's today's chart of the day. So we can go back for, you know, for the past couple months and see, you know, what was the chart of the day on April 5th? Is it up or down? You know what I mean? So I track everything on the website with the spreadsheet.
Can you share the website for a second, since we're talking about it?
Sure. You know, Michael, it's funny. I just happen to have it right here. How did you know? So it's Blue Chip Daily Trend Report. BlueChipDaily.com is the web address, and probably the coolest part of the website. If you go onto the blog, so I blog quite a bit. I usually do a lot of videos. So like I did a video on a Netflix position I've got. You know, a lot of charts. But if people want to see the trade alert, so for example, you know, Square. So when I made Square the chart of the day, so it was May 7th, and I put it on the premium Twitter feed. So I do one every single day. And then we just post it. So every time I post an idea, it always has a stop level, no matter what, whether it's a chart idea or one of my positions, because I want to know right away, because any single stock can go down. You know, they can go down for any reason, or they can go down for no reason. So what I want to do is, as soon as I get into the position, I set my stop. If I get stopped out, I get stopped out. But every single idea has to have a stop.
That's great. And the transparency, like it's beautiful. Like more people need to be as transparent.
Thank you. Thank you.
Question from Lynn. Do you use any hedging strategy when market is under pressure or to minimize drawdown?
You know, that's a good question. And it's something that I covered over the weekend recently for members. But for the most part, the most hedging that I do is just raise my cash allocation. So I don't get into too much hedging. If I were, it would be a simple index short, like short SPY, short triple Q, you know, something like that. But for the most part, I don't get into too much hedging. What I'd rather do, take my profits, you know, scale out, raise the stops. So when the market started to unwind at the end of February, and you know, that was a pretty dicey time. But what I had done is I had raised my stops, and then I just stopped buying. I stopped taking new positions. So as the market started to go down and the stops went off, you know, the cash would just build in the account. And that was really the best hedge for me, is more cash and reduced buying activity. But if I were, and I'm not against hedging, and it's something that I could do at any point in the future, but something simple like either just an ETF short or an inverse ETF, you know, short triple Q or short SPY, I think that's probably the simplest thing to manage.
So would you short shares of stock or no?
No. So I really don't short individual stocks anymore, because it can be too volatile. You know, if you short whatever Tesla and it gaps up 10% one day. So what I found is I just short the ETFs. And, you know, the last time I was really heavy, so I wasn't short anything. So when the market unwound February to March, I didn't short anything because the move happened so fast that I didn't even get into a short. But the last time that I was really heavy short at the end of 2018, I was pretty heavy short triple Q, and I was short like 70% of my account was short triple Q, and I was very comfortable being short the index, but I wouldn't be as comfortable being short, you know, AMD or shop, you know, they'll shut your account down a couple bad days. So I don't short the stocks, but I short the index.
That's great. Question from Sal. How do you establish a position? Do you buy all at once or do you scale in?
For the most part, I buy all at once. So now here's what will happen. So if I want to take a position and it's going to be, let's say, I'll start with a 4% position, then I'll buy all 4%. But if the trade starts to work and then over time I want to add more to the position, I'll do that. But generally when I want to, unless it's a really volatile stock, if it's a really volatile stock, then I might go in with half. And then if the trade starts to work, I'll add more, but I won't add more on the way down. So I don't average down, I'll just add it on the way up.
And how do you determine how much to add?
I generally treat it as a new position. So if I start with a 4% position in, you know, whatever the stock is, and it starts to work higher, I'll either add incrementally or I might just double up my position. So for example, I'm in GDX and GDX started to work. So I wanted to add another
gold. Bring up GDX?
What's that?
Do you want to bring up GDX?
Yeah. So I'm in GDX, and what I wanted to do is I got another signal on gold miners probably a week and a half or 2 weeks ago. So okay. I could have either doubled up in GDX or instead I added a single stock gold miner, but I took a full position.
Interesting. Let's see. Well, wow, we're already 20 minutes over. I want to be respectful of your time too. Do you have time for another question?
Yeah, I've got probably another 20 minutes or so.
Awesome. All right. Well, thank you, Larry.
Hey, thank you for having me on. I appreciate it. We've been talking for a long time.
Yeah, it's great to talk to each other a lot, like face to face. Or
yeah, no, I really appreciate having me on. It's great.
Larry, do you use volume in your entries and exits? Does volume matter to you?
You know, that's a great question, and I think I hear that question probably a lot because it's a really good question, but I don't. And the reason is that I've never seen. Now, I will say this: when I'm in a position, if a ton of volume comes in, then that's nice to see as a confirming indicator. But I take the signals based on price and the price signal and not volume. So for example, if I get a, you know, like when I bought Square, or if I get a signal, if I'm going to buy NVIDIA, you know, I bought NVIDIA on a breakout, I'm not looking at the volume. So once again, I know that there's a whole school of thought, you know, you have to have so much upside volume. At the end of the day, I've never seen a study, and you'll see if you look we'll look at triple Q for a second. But here's the thing: if you look at the volume, you can see if you look at the downside volume here and the upside. Look how lower the upside volume is than the downside volume. But you can see the stock still kept trending higher, and then even on the recovery, it had a lot of downside volume. So I bought into the tech stocks, right, coming out of March. But if you were a volume trader and said, well, you know, there's no volume there and there's no volume, you know, I don't trust, and I saw it a lot. Look how low the volume is. You know, I saw it a lot on Twitter. People say, I don't trust the rally because there's no volume. And then you look at the price. You see what I mean? So I'm just going to look at price. If I'm in a position, it's great when volume comes in. And I won't say there's anything wrong with using volume, but I don't use it. Yeah,
it's almost like giving too much leverage to any one thing, right? Like I like to to look at the entire picture first and then come up with an assessment versus like, oh, well, volume is low, so throw everything out the window. It's like, well, volume is low, okay, but what about, are there stocks setting up?
Right.
Or, well, what is this? Well, what are the other indexes doing?
Yeah, I just, it's nice to see the volume, but, and I make this joke sometimes on Twitter, and sometimes I say things on Twitter, and I try not to sound like I'm coming off the wrong way, but there's no volume qualifier on your P&L statement. Price and quantity. So, so if I'm going to buy, so like a lot of times I like to buy a price breakout, so just like we talked about. So if you're going to buy, XYZ stock when it goes over $100 a share, I'm just not going to look at the volume. And I know that a lot of people might, feel differently, and I won't debate them on it because everyone does what works best for them. But, I've never seen a study that said that, this stock went up, whatever it went up, but, it had to have volume.
We have a couple of people asking about the reminiscences of a stock operator.
I love it.
So can you hold the, let's turn off the screen share. So
yeah.
People can
oh, sorry about that. Okay, so here it is.
Yeah, so we've got that one, reminiscences of a stock operator.
Yeah.
We have the other one, from Van Tharp.
Yeah, the Van Tharp. So trade your way to financial freedom.
And what was the name of the Martin Zweig book? I read it also. That was actually one of the first ones that I read that turned the light bulb on. Like I read plenty of other stuff before that, but that was one of the first ones that I read. I actually read him, and then I read O'Neill.
Yeah, so
Winning on Wall Street. Yep.
Winning on. Now, here's what I will tell you. So Marty's book is very good for, I think, general concepts. So he talks about, one of his concepts that I love, don't fight the tape, which is great. He also talks about don't fight the Fed. But, if people are looking like for more, technical, like Marty's book, but Marty's book was written in 1986. So it's going to be a little bit different content than what you're going to find. Like if you compare it to Bill O'Neill's book, Bill O'Neill's book has probably 50 times as much technical analysis and charts. Stan Weinstein's book is probably my favorite for just pure charts.
That one.
Stan's book. So this one, and that's another old one from like 1986. But this is Stan's book as far as using just price and moving averages is really, and his was one of the books. You see, here's the thing. You don't need to know everything about everything to make money. And it took me a long time to figure that out. And Stan's book is great because Stan's book is all about two things. Price, so he's got 4 stages of price, right? Stage 1 base, stage 2 accumulation, stage 3 where it flattens out, stage 4 when it goes down. And then he uses the 30-week moving average, which is the 150-day. But his book was great because it just talks about price and the moving average. It doesn't talk about, GDP and, what consumer, sentiment is and all that stuff. And it's just a great book for price.
100%. That was, like rattling off all my favorite books. I love it.
They're classics. They've stood the test of time. It's not sometimes, my belief in life is that blocking and tackling, it's the basics. If you can just get really, really good at the basics, you can be successful at almost anything. And, it's like, I think it's Vince Lombardi said, let's just get really good at blocking and tackling and let the other guys do all the fancy stuff.
Since we're on the topic of books, another one of my personal favorites was Nicholas Darvis.
Oh yeah.
How I Made $2 Million in the stock market. And
it's a great book. And the thing, and that's another one that taught me, because he got his signals by a telegram, right? So I mean, he woke up the next day and saw that whatever Texas Instruments closed. So that's a great book because that's all price. And he's got his boxes, and when it broke out of the box, it's a phenomenal book.
Yeah, how easy do we have it?
Yeah.
Right? If he could do it,
sometimes it's too easy. Sometimes it's too easy, but no, these books that have been around for, 30, 40 years, that they keep getting mentioned for a reason because they're the basics.
Mm-hmm. Yeah, he was one of my primary sources of being able to do this stuff starting out part-time.
Yeah,
All right, like a ballroom dancer traveling the world and able
yeah.
to,
It's a really neat story.
absolutely. Um, Here's a question from Anonymous. Do you sell just based on individual stock action or also sell if the index is not acting right?
So I won't sell if the index isn't acting right, but I'll stop buying stocks if the index isn't. So what I did in February, because I went from in February, I went from probably 75 or 80% long to zero long in a short period of time. And all I decided to do was when the S&P broke 3,200, I just stopped buying stocks. But I let my other stocks, let their individual stops get hit. Now I will raise some stops, right? So I'll raise stops along the way. So if the market starts to unwind, I'll raise stops on a position. But I generally won't go in and just cut a position because the market's going down. But I definitely will stop buying if the market starts to unwind. So what my strategy is I buy the pullback until it stops working.
Mm-hmm.
And then when the pullback stops, so if I'm buying pullbacks and they're working and going up, then I'm going to keep doing it. But if I start to buy a pullback and the stock starts to go down, or I've got some other stops that are being hit over here, I'm not going to keep chasing stocks on the way down.
How long do you give it to until it stops working, right? Like, so let's say like you initiated, you're buying the pullbacks, then, oh, I bought the pullback, it stopped working. Are you stopping right there at one or
one or two? Yeah, one or two. So if I buy a stock, now obviously they can have a little pullback, couple 2, 3, 4%, but once a position starts to, if I'm down 10% in a position, and also I have to look at the overall market. Did I just buy the stock wrong and is the rest of the market going up? But if I'm buying the pullback and the stock is starting to go down, and then my other open positions are starting to go down, it's like with software stocks. So I've got a lot of, I've got more software stocks than anything else. But I also know that they're very highly correlated, and when they all go down, they go down pretty quickly. So if I buy, a software stock today, and it starts to, like, they all sold off over the past 2 days, right? Shopify was down a little bit, Datadog, some of the higher momentum software stocks, CrowdStrike, they pulled back. So if I buy the pullback and the position doesn't start to work, and then the rest of that group is pulling back at the same time, I'm generally not going to buy another pullback buy in that group until the group starts to turn back up. And that's what prevents me from burying myself on the way down.
So are you following the IBD, their group ranks? Is that a factor or?
No, not really. What I do is I run a lot of scans through the day as far as relative strength goes. That's really one of the key things that I look for. So I track every day about 35 ETFs, right? And it's the big stuff. Like someone just asked for Stan Weinstein's book, so I don't know if people can see that. But what I'll do is I'll track these ETFs through the day. And what I found is that the stronger, it's kind of twofold, but the stronger ETF group will lead me to the stronger stock. So like if you run a scanner right now, I think the highest relative strength ETF that I track was, is cloud software. So if I see that, or, China Internet is strong. So if I see that the China Internet ETF is ranked one of the best on my screen by relative strength and price performance, then I'll dig into the top 10 holdings. And then you'll usually find that the strongest ETFs hold the strongest stocks.
Yeah,
that's how the ETF got, right? The group is only as strong as the individuals.
Yeah. So we want to be in the strongest name in the strongest groups.
That's what works for me. Every so often I deviate and I start to, go into this, the weak stuff on the, look for the recovery. And so I bought energy at the right time, and I bought industrial metals at the right time. But then I took a pullback buy in Boeing and General Electric recently, and they just kept pulling back. And so I got stopped out. And then, when you deviate and it works, you're like, okay, well, you know, I got it right. But then when you deviate and it doesn't work, you say, well, why did I do that? So for me, you know, focusing more on the strongest stocks and uptrends, really just, it's a lot better for me.
So do you track, like, how do you track those? Like, is all that getting logged into the spreadsheet?
Yeah. Yeah.
So you have it logged, like, okay, like I deviated on this and here's why. And
no, I don't. So I don't have that logged on the spreadsheet. No, I know that after having been doing this for a long time, I don't have to track, you know, I deviated from and it went wrong. I just know the next time, just, you know, click out of the Boeing chart the next time. Now that I said that, Boeing will probably go straight up because that's how the stock market works. But, you know, it's just one of those things that what's made my life easier is, you know, when I first started, I would have a lot of stress because I felt like my job was to look at a chart and figure out, do I think that chart's going to go up tomorrow? And that's a tough way to manage, you know, looking at all these charts. So instead, what I did is I do it backwards. And I just have a process that works, you know, a technical process that works best for me. And then I ask myself, does this fit into my process? So if it fits into my process, then I'll consider looking at it further. And if it doesn't fit into the process, then I don't think about it anymore. And I found that doing it that way makes it a lot easier for me.
That's brilliant. That's brilliant. I like that a lot.
Yeah, well, it's one of these things where, you know, like if you have exclusionary rules, so if my rule is I don't buy downtrends, then if I see a stock and it's in a downtrend, I just move on. It's, you know, it takes me 2 seconds to figure that out. So if, you know, or if I have a rule that I don't buy, you know, whatever, you know, anything in a downtrend, even when I bought the other 2 stocks that were under the 200-day, they were at least in an uptrend and they were breaking out. And then I just bought the pullback and the breakout, and I got it at the wrong time. So it happens. But at least they were breaking out. It wasn't something that was in a downtrend, and I was trying to jump into the downtrend. So it wasn't as bad. It didn't work out the way that I wanted it to, but it happens sometimes. You know, the risk reward was good that if the trade worked out, then the math would have worked out. But they were still breaking out. I just caught them at the wrong time.
We only have a couple of more minutes.
Okay.
I want to ask you then, what are some of your other exclusionary rules? I think that
there's a lot. It's probably simpler to tell you what I do look for. So
okay,
I'm just starting to look at mid caps. Okay, but I won't buy into downtrends. I won't buy like these like there's certain like some of these biotech stocks, like these small cap biotechs and some of these small cap, you know, whatever that's, you know, pretty popular with the day traders. I just don't buy into any of that stuff. For the most part, what I'm looking for is $10 billion and higher, 1 million shares or higher in a high relative strength industry in an uptrend. But they're really the key industries that I focus on. Tech, at any given time, tech is probably, you know, 40% of what I hold, maybe 50%. China internet, I focus on. Healthcare, biotechnology, you know, it's what's in an uptrend. If banks go into an uptrend, so if the banks are doing pretty badly, but at some point the banks will be back over the 200-day moving average. It might be 3 weeks, it might be 3 years, we don't know. But at that point, once they start to break out, like there was 2, like Morgan Stanley was breaking out and Goldman Sachs was breaking out. So if the rest of the group started to break out, then I would take a look at those stocks too. But for the most part, I'm looking for large caps, high volume in an uptrend in a, you know, high relative strength industry.
One more question before we go. Do you mind putting the website back up so that way and let us know too? Like, so
Sure.
So you have your website. So the website is there, bluechipdaily.com. We have your Twitter, all right?
Yep.
Your Twitter is LMT987.
978.
978.
Yes, sir.
What other ways can people get a hold of you? Or are those the best 2?
Twitter or the website. So on the website, there's a contact page, or on Twitter, that's the best way. I've got a LinkedIn page, but I'm never on there. I'm not really good with Facebook and any of the other stuff. So really Twitter and the contact page is probably the best way.
Any closing thoughts for people here that are maybe that they're just getting started and they're trying to figure out well, what should be their next step?
Yes. Here's what I would say. What's worked best for me, and we kind of started to touch on this, is to do less. So when I say, are we stuck in Zoom land? Are you still there?
Yeah, I'm still here.
Okay. We were kind of like.
It was frozen for a second?
Yeah, something like that. But what I would say to do less of everything and focus on doing more things right. So often when I talk to new traders, because I've got friends and family members and they're, everyone discovers trading at some point, right? And I've got a cousin, so he was into, day trading options on space or whatever that is, Virgin Galactic, I think it is. And he made a lot of money and then he gave it all back like in 2 days. But what I would say is to make a lot of money trading doesn't constantly mean having to do something, right? So if you get into Square, so Square's up, 45 or 50% since I bought it in May. And the temptation may be to sell it and then buy something else or Square was down. I think when I first got into it, it got downgraded by Merrill Lynch or some bank for whatever reason. And it was down 4% one day. And a lot of people will have the temptation, or Facebook over the weekend. So Facebook got hit on Friday. It gapped down, or it started down yesterday, and now it's up like, I think $15 since then. The temptation is, okay, well, things look bad for Facebook today, so I'm going to get out of it, and then I'll buy it back later. And then the stock, it's at new highs. It's just an example. So I would just say, you don't have to be a day trader and a swing trader and a position trader and go long and go short and trade options. And you see what I mean? You don't have to do all that. You just do, find what works. If you're a great day trader, great. If you're a great swing trader, that's great. If you're great with options or great with short selling, or that's your strength, it's great. But I would try to find what works best for someone, and then excel at getting really, really good at that, and stop trying to do everything, because you don't have to do everything.
Great advice, great words of wisdom. Larry, I can't thank you enough for being here. This has been absolutely incredible. I can't wait to go back through this and listen to it again and get all these gems. This should be up on YouTube in about a week.
Okay.
In about a week, by the time that my editor is done with it. But
awesome.
Again,
Michael,
thank you so much for being here.
I just wanted to put this out there for you and for the people that are here right now and that watch. You do a phenomenal job. You help out new traders. You help out all traders. And that's the key thing, is that if we can share with people the mistakes that we've made in the past and help them get better. Tom Basso helped me. And I don't want to have everyone reach out to Tom. I get hesitant when I say everyone's going to send Tom Basso a Facebook message. It was something that developed over the course of months, and I would always think, like, I wouldn't just send him a question and say, hey, what do you think Apple stock is going to do tomorrow? It wasn't something like that. I would maybe be stuck on something for about 3 weeks and then just send him a message. But the key thing is that what you're doing with these podcasts that you have and with the educational work that you do, anything that you do or that someone else does that can help people cut through, a lot of the common mistakes, and help them develop along the way, it's very good. So, I respect you for the website that you've got. I respect you for the work that you do. And I appreciate you for having me on today.
Thanks so much, man. I really appreciate that.
Yeah.
And thank you, everybody, for being here. Great questions from everybody. This was amazing. Look forward to talking to you again real soon, man.
Me too. Thank you, everybody, for joining. I appreciate your time, and I'm glad that everyone was here. I hope that it was some value.
Absolutely. Take care. Much love. Peace out.